Hi ladies, this is your chapter 5, planning and the budgeting process. Let's first take a look into what's a budget. As you can see, a budget is an operating plan. See, basically budget is planning for future. Budgeting is planning for future. So when you're planning for future, you do it based on a plan. In the context of a company or a business organization, a plan is basically an operating plan. That means a plan is prepared for the operating activities of a company. Operating activities meaning the business activities, which is concerned with manufacturing, selling, etc. It shows how resources will be committed during the coming period. This usually means when a company has a plan or when you have a plan, you exactly know how to use the resources and what resources will be required in future. It communicates corporate direction and coordinates corporate efforts, which means that plans, if you have a plan, if you have a budget, it helps in better coordination. Alright, so let's start with what exactly you will be doing under budgets. So the first thing that you will be doing is understanding and preparing a master budget. A master budget consists of all the operating budgets of an organization. Let's look into what are the components of a master budget. As you can see, right on top and at the center is the sales budget. There is a reason why sales budget is the first budget. Sales budget is the starting point of preparing a master budget. If you don't have a sales budget, you cannot prepare any of the other budgets which are shown in the chart here. Because if a company does not know how much it wants to sell in future, how would it know that how much it needs to produce and how much materials will be required for the production? What will be the direct labor requirement? What will be the expenses on direct labor? How much will be the selling and administrative expenses, etc. So all of these budgets, as you can see here, right down to the cash budget and the budgeted income statement, the balance sheet, they are all dependent on the sales budget. Unless you have a sales budget, you cannot estimate any other budget. So therefore, sales budget is the most important budget of any business organization, and based on the sales budget, the other operating budgets are prepared. So right under the sales budget, you have production budget. Production budget will give an estimate of how many units of a product a company needs to produce in order to be able to sell the budgeted number of products. Based on the production of the final product, a company estimates how much direct material is needed for the budgeted production and what will be the other manufacturing overheads required. So one is the materials purchase budget and the other is the manufacturing overhead budget. You know that these are the components of any manufacturing expenses as you have learned in the previous topics. And a direct labor budget also is estimated or prepared based on the production budget. Based on all the other operating budgets, right from the sales budget until the ending inventory budget, a cash budget is prepared, which means a cash budget includes the information from all the other operating budgets. So that's the last operating budget that you will be learning. Budgeted income statement and balance sheet is not included for you. Okay, so then let's begin with the sales budget. Sales budget, why is the sales budget prepared? You need to know that first. A sales budget is prepared to know what will be the sales revenue from the budgeted sales for a certain period. Please bear in mind that it's very important to be able to prepare a budget. The period of time is important. Every company needs to know what is the duration for which the budget is to be prepared. Typically, budgets are prepared for a shorter duration, not more than 3 to 6 months, because the longer the period for which the budget is prepared, the more possibility that you will go wrong in your estimates. Estimates are always good when it is in the short term. The moment estimates are made for a long period of time, more chances of them going wrong. So period of time is very important, and sales budget helps to know the sales revenue for that period. So what does a sales budget starts with? A sales budget first begins with the forecast sales in units. Any business organization needs to know that how many units of a product will it sell in future. And followed by, they need to know the selling price of those products. So the important information that you need to prepare a sales budget: A, you need the number of units to be sold. That means the budgeted sales in units, and you need to know the selling price. Based on these two information, a sales budget is prepared finally to get the sales revenue. And it is prepared for each of the product which a company sells. Let's look into an example or a numerical. So this is how a sales budget looks like. This is from Exhibit 5.5. Alright, so as you can see, the months are October, November, December. So this is for a period of 3 months. A period of 3 months is also called a quarter. Budgets are typically prepared for maybe each of the quarters during a year. So the first quarter is January, February, March. That's called quarter 1. Second quarter is April, May, June. Third quarter is July, August, September. And the fourth quarter, which is the last quarter of a year, is October, November, December. So this is the fourth quarter, and the columns are for the 3 months for which the budget is prepared. The last column, as you can see, it's written fourth quarter, which means this is the total column. Alright. You always begin with the budgeted units which are going to be sold. So these 10,000, 20,000 and 40,000 are the units which will be sold during each month. And in the whole quarter, a total of these will be sold. So 10,000 plus 20,000 plus 40,000 gives 70,000. This is the total budgeted sales in units. Now you got to multiply this with the selling price. Selling price will be the same because this is for a particular product, which is baseball pants, which is $12. So you would put $12 under each of the months, and you will arrive at the budgeted sales revenue for each month by multiplying the units sold with the selling price. So as you can see, for the first month you have $120,000 and so on until December. And in the fourth quarter, you would be selling a total of, or you would be receiving a sales revenue of 840,000, which is a total of 120,000 plus 240,000, which is and 480,000. So 840,000 should also match with your total units sold when multiplied with the selling price. In this way, the company prepares the sales budget for each of the products which the company sells, and then it compiles a sales budget for all products by bringing down the budgeted sales revenue from each of the for each of the products. But what you have to just know is that how is it prepared for a particular product, so which is this schedule. Alright. Similarly, the company also prepares selling and administrative expense budget. A selling and administrative expense budget shows expenses which will be incurred in future to support the budgeted level of sales. A selling and administrative expense must include both variable and fixed selling and admin expense. This is how a selling and administrative expense budget looks like. We move on to then the production budget, which is included in your course outline and which will be included in your exam. This shows when and how many units to produce in order to meet the budgeted sales volume. So production budget will basically help the company to know how many units of the product will have to be produced in order to meet the budgeted sales volume. Note that a production budget must take into account both ending inventory as well as beginning inventory of the finished goods. Here you need to know an important information, and that is a company will never produce exactly the number of units that it needs to sell, because it needs to be prepared for any future requirement, any unexpected increase in sales. So it always produces some additional number of units to meet the sudden unexpected demand for the product or sudden increase in the sales. Therefore, this additional amount that a company produces remains as an ending inventory every period, which means that a company will not produce exactly how much it wants to sell, but it will produce how much it needs to sell, that is budgeted sales, plus how much it needs to keep as ending inventory, which means that ending inventory of every month or every period must be added to the budgeted sales in units. Note here another important point: production budget will always be prepared only in terms of in units. It is not in dollar or dirham. A production budget is prepared in units based on how many units a company will sell. Another important thing that you need to know before we start the exercise is that since every period a company will maintain an ending inventory, therefore in the next period a company will always begin with the beginning inventory. Now, if the company does not take into account this beginning inventory every month and keeps producing the budgeted sales plus ending inventory, it will have too much of excess inventory. Now, no company would want to do that, because that results into wastage, that results into additional expenditure, and there will be too much of inventory, which will not give a true picture of the net income of a company as you have done under absorption costing versus variable costing. Therefore, every month, whatever is the beginning inventory of that month or that period has to be deducted to arrive at the correct number of units to be produced. Look into this numerical on production budget. It starts with the budgeted unit, because if you don't know the budgeted units, you will not know how much to produce. So you will begin with the budgeted units to be sold for each month, which is from the previous budget 10,000, 20,000 and 40,000. The budgeted ending inventory is always given in terms of certain percentage. Let's look at what percentage you need to follow. Look at the information here. October's budgeted inventory, beginning inventory, is equal to 25% of October's budgeted unit sales. So that's about the beginning inventory. December's budgeted ending inventory is 25% of January 2015's budgeted sales of 38,000 pairs of pants. Alright, so which means that in the budgeted